What is going on, traders? Welcome back to the Traveling Trader. Yes, I know my hair is long. Yes, I know I look tired. It's just the sun. You guys need to stop leaving these comments. Actually, I don't really care. I find them endearing. Anyway, in this video, we're going to talk about two major hurdles that the stock market could face coming up. One of them I don't think is priced in. The other one might be slightly priced in. Anyway, let's get right into it. You can see here that the stock market is still down. NASDAQ down 28%, S&P down 17 to 18%. So is it time to buy? We are getting awfully close to those June lows right here. So, are we going to get there? Are we going to break them? After World War II, the S&P 500 has never made new lows in a bear market if they've recovered 50% from that peak to trough decline, which we've already done in the stock market. But here's when you say this time it could be different and actually mean it. We've never had quantitative easing to this level, and don't worry for you newbies, I will explain it in a second. And likewise, we've never had quantitative tightening like the cycle that is coming up in September. It is already September as of the recording of this video. So this right here, this chart right here is the Fed's balance sheet. Quantitative easing is when the Fed provides liquidity to the economy. The way that they do that is not only by lowering interest rates so that the cost of money is cheaper, thereby people and businesses alike borrow money until, kingdom come, but they also buy assets in the form of treasuries, mortgage-backed securities, and other assets that they keep on their balance sheet. And they're buying it because they're providing liquidity to the market. So when you hear the term, oh, the Fed is printing money, they're not actually sitting there with a printer printing money at Kinko's. What they're doing is they're buying assets from the government and from institutions and giving them money in exchange for those assets, and they are keeping those assets on their balance sheet. So that is called quantitative easing, meaning easing of monetary policy. This is a relatively new practice, one that really was only experimented with after the great financial crisis of 2008. Now, the quantitative tightening, which is the reverse of that, meaning letting assets roll off of the balance sheet and or actively selling assets off the balance sheet, is also something relatively new. Because we've never had assets on the balance sheet as high as 9 trillion, we've also never had a cycle of quantitative tightening that's going to involve $95 billion of rolling the assets off every month. This is starting in September. This is the big unknown. So this right here, I believe, is not priced in yet. We always talk about interest rates. We have the Fed Watch tool that shows us what market makers and institutions are betting that the Fed funds rate is going to be. In this case, we're looking at a 75 to 100 basis point rate hike for the September 21st meeting. But we don't really talk about, and economists haven't really discussed what are the real effects of quantitative tightening. Part of the reason is because they don't know. It is brand new. But logically, if we look at this chart and we say, okay, every time the Fed has actually purchased a large amount of assets, we've seen the stock market go up and the economy do well. That's because the economy is just pumped with liquidity, right? Well, what do you think is going to happen in the reverse? Is it logical to think that if the Fed actually does shrink the balance sheet aggressively and takes away liquidity from the economy, that's going to end, smoothly? If we've had a violent run-up, especially after the COVID crash of 2020 that lasted all but 5 minutes, do you think that now aggressively quantitative tightening is going to result in a soft landing? Also, it's important to note that quantitative tightening, which actually started in June, not in September, is just tripling in acceleration by September. The Fed hasn't really held up their end of the bargain. Quantitative tightening was supposed to happen to the tune of $35 billion a month since June. So June, July, August, we are now in September. So almost 4 months have passed, and the balance sheet has only dropped by 63 billion, where you can do the math. It was supposed to drop by over 100 billion, 105 billion if we're talking about 3 months. And we're nowhere near that. We're almost at half of that. And if we look at this correlation between the Fed's balance sheet and between the stock market, you could see that the market is actually addicted to Fed policy. This becomes even more evident when you look at the federal funds rate. I've shared this time and time again, but the effective federal funds rate, meaning the federal funds rate minus CPI, so adjusted for inflation, has really been negative since 2008, with a few brief months popping up, popping positive in 2009, again in 2015, and again in 2019. But again, those were so brief that they're outliers. The effective federal funds rate has effectively been negative for, what is this, 14 years now almost and running. And this led to the greatest bull market of all time. So yes, the market is addicted to Fed's easing of policy. So what happens when you remove that mouth from the teat of the Fed? Well, you can probably guess what's going to happen, especially if it's done violently. And then the effective federal funds rate is still negative 6.8. We've never gotten out of a bad inflationary situation. If you go back and look at the worst inflation that the US has ever experienced, really between 74 and 82-ish, you could see that the Fed had to aggressively ensure that the effective federal funds rate was positive, meaning the Fed funds rate minus CPI. So in this case, if inflation is still high, the Fed's going to keep having to ramp that thing up until the Fed funds rate is above CPI and the effective federal funds rate is positive. This is why we continue to maintain a short position on the market, because of these unknowns. And I personally don't think that QT, quantitative tightening, is actually priced in. And plus, we have a plethora of unknowns and really not, not any news to look forward to. But there is that second factor, that second X factor that I'll talk about. But this is why we effectively maintain a large number of short positions. We have the triple Q's credit call spread, the Tesla credit call spread. Shout out to those who watched the video on how to trade Tesla post split. That spread is now up 70%, and you can close it and take profits if you wish. We bought puts that were up over 100% on Tesla. We have the covered calls on Apple and Tesla. We have a short on the futures. There's just a ton of ways to short the market. Follow me on Instagram and on Twitter. I put out finance content every day, talking, little tidbits, a lot shorter than YouTube, talking about how to navigate these markets. So if you guys like finance content and travel content, follow me there. But this is why we maintain these hedges against the market, and we do so pretty successfully because the market as of late has been one directional since it hit that peak in August. I'm talking about this peak here really completing the fractal, the same one that we saw between January and April, is almost the same one that we saw between April and August, right? So this was the peak right here. This is when we started, from a technical perspective, maintaining or opening those short positions. And by the way, it is September, so new spots have opened up. If you guys want access to the Academy, where you get the day trading course, the options course, you get the Zoom calls with me that we do on weekends with a large group going over trades, strategies, etc. You get to ask me any question you like. You get access to the chats, the alerts, my analysis, what I'm buying, what I'm selling, what options I'm getting into, what futures I'm getting into. It's a really jam-packed group. So those slots just opened up. Make sure to sign up, book a call with an ambassador before those slots close up again, and you won't have the opportunity until next month. And if you guys want me to do a segment, I was thinking of doing a segment on this channel called like TA Tuesdays, and just running through a pure technical analysis of the markets and of some of the high profile mega cap stocks. If you'd like that, leave a comment down below and let me know that you would be interested in a series like that, like TA Tuesdays or TA Thursdays. And I'd be happy to do those because I enjoy doing TA. It's just, it's not for everybody. And I try to make broad-based videos about the markets that people will appreciate. So let me know in the comment section below, and I'll explore the possibility of doing that for you guys. The second factor that we need to watch out for is earnings growth, muted earnings growth, or even a decline in earnings growth in stocks, what we call earnings compression. So based on all of these factors that we have going on, we have the energy crisis in Europe, quantitative tightening about to triple in aggressiveness. We have the rate hike still going on. the economy is slowing down. We obviously have a major slowdown in the housing market. For those of you real estate professionals, you know what I'm talking about. This will all lead to a reduction in demand, a reduction in spending power, a reduction in purchased goods and services, a reduction in the value of earnings. And there's a huge correlation between Morgan Stanley's leading earnings indicator, which they calculate based on ISM manufacturing, based on consumer confidence index, housing starts, credit spreads, and they take all of these inputs and plot them on a graph against EPS, or earnings per share growth, year over year. And if you look over time, this is actually one of the best indicators I've ever seen plotted on a side-by-side graph. And it suggests that there's actually a drop in earnings that is going to come from an economic slowdown. Again, what we call earnings compression. Michael Burry talks about this a lot. So we already experienced what's called multiple compression, meaning the ridiculous multiples that stocks were trading at. We saw a compression of those multiples, right? We saw stocks like Roku and Zoom. We saw stocks like Teladoc, Snap, really any stock that you can think of that's not a mega cap, but even the mega caps like Meta, which used to be Facebook, stocks like Netflix, they saw what we call a multiple compression, meaning the stock market, when there is a clear downturn in the economy and in the market, the stock market is going to force those companies to prove those valuations. And if they can't, then there is no reason that they should be trading at those levels. So you saw the multiples compression, but the earnings compression hasn't yet hit because obviously, we need these earning guidance reports and these earnings reports to actually report that the expectation is going to be lowered EPS growth. And then we'll probably see a bunch of downgrades, et cetera, due to this. So these are the two things that I don't think are priced in. The QT much more so than the EPS compression. But these two things are things that I think you should watch out for. Now, from a technical perspective, if the S&P 500 closes below 3,800, then I think there's a chance that we match those June lows and potentially go below them, especially if quantitative tightening actually ramps up and the Fed does what it actually said it's going to do, especially if they raise rates aggressively like they said they were going to. However, this all depends on the Fed. As we saw, the stock market is addicted to Fed policy. So if the Fed actually comes out, the Fed can do what it wants. As we see, they already told us that they would quantitative tighten, but they haven't kept their end of the bargain, and they've been doing it at a much less rate than advertised. Jerome Powell came out in Jackson Hole, guns a-blazing, talking about how they will stop at nothing to tackle price instability, even if that means that unemployment ticks up. However, they can come out in their September 21st meeting. They can look at the CPI report that's coming out on the 13th, and they can be like, hey, you know what? Actually, inflation is coming down. The economy is slowing down. There's no need to be aggressive. So we're just going to do a 50 basis point rate hike, right? That's very possible. We're at the mercy of the Fed. So if they tighten according to schedule and raise the monthly tightening cycle by $95 billion on the balance sheet, if they actually raise rates by 75 to 100 basis points, then I do think that the market will actually decline more, especially if that earnings compression that I just talked about becomes a thing and companies start reporting negative earnings or negative guidance, or we see a bunch of downgrades on stocks because the institutions are expecting that their EPS comes in less than what they think. But if the Fed halts QT, if the Fed does a pivot, or what we call the Fed pivot, if the Fed actually doesn't raise rates like they said they would, I mean, yes, you can see a bottom near the June lows and the market will continue to go up again. That's just how it is. It's been very Fed dependent. Keep in mind that September is the worst month for stocks. Keep in mind that we are in a midterm election year, and that is even more exacerbated before the midterm elections. Stocks don't tend to really take a break and go back up until after the midterm elections. But I would urge you to focus on September 13th, CPI, and September 21st, the Fed meeting. That's going to tell you a lot about whether the stock market has found a recent bottom or not. Hopefully this was helpful to you. I just try to provide you guys with as much helpful info as possible, as much up-to-date info as possible. I don't BS you guys at all. I have no agenda here besides to present you with an accurate reflection of the market and tell you how I'm playing it. So hopefully you got something out of this. If you did, leave it a big fat thumbs up. Again, follow me on Instagram and Twitter if you want daily finance content, and you get to follow my travels as well if you guys are curious. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.